Well, hello again, and welcome to all of our Fellowship Financial Group friends and family. It's time for the pre-spring edition of our market update. I'm Michael Eastham, president of Fellowship Financial Group. The financial markets weren't entirely free from drama in February, but overall, things remain quite calm as we entered into the final month of the first quarter of 2024. Can you believe it? But the drama, such as it was, stemmed from a slowdown in falling inflation, which prompted the Federal Reserve to back off slightly on their commitment to start lowering short-term interest rates sometime this year. Although the Fed says they still intend to start bringing rates down again after raising them at a historically aggressive pace for a year and a half, Chairman Jerome Powell said in a statement that the reversal won't happen until they've gained greater confidence that inflation is moving sustainably towards 2%. 2% has always been the Fed's official target for the inflation rate, and they're certainly much closer to that target now than they were a year ago when inflation was still over 6%. And in my book, anything above 0% is robbery. But I digress, of course. Last month, inflation numbers for January came in at 3.1%, slightly higher than the 2.9% rate that economists were expecting. And this news sparked a knee-jerk reaction and a sell-off on Wall Street and set long-term interest rates trending upwards. In fact, the interest rate on the 10-year government bond started February at 3.87% and ended the month at 4.25%. Well, how did this bit of drama affect everyday investors and your portfolio specifically? Well, the answer is not much. Despite that knee-jerk sell-off that I mentioned, the S&P 500 and the NASDAQ both ultimately hit new record highs again last month and enjoyed their best February performance in nearly a decade. Overall, the stock market remains up by over 6% for the year. Yes, much of that market strength is still being driven by the artificial intelligence tech rally that took off last year, but beyond that, investors also seem generally optimistic about the economy based on the latest data, which is mostly strong, especially knowing that the Fed is ready and willing to lower interest rates again if the economy starts heading south. Even the stickier than expected inflation numbers for January are essentially a sign of economic strength since that exactly means that demand is high and consumers are still spending. As a result, GDP growth for Q4 of 2023 was an estimated 3.2%. That was down from the third quarter's 4.9% figure, but still indicative of a healthy, growing economy. And the latest employment numbers indicate the same thing. As for the spike in long-term interest rates in February, even that had minimal impact on most investors, as evidenced by our portfolios. As you'll see on your latest statements, if you're in one of our portfolios of individual bonds and bond-like instruments, your total return, if you're not taking income and depending on your individual holdings, is still up by 1% on average year to date, which means that annualized you're on pace for about 6% total return for the year. That, of course, is our target goal for bond and bond-like instruments. To get you to a 5 to 6% annual income stream net of fees, that's what happens when you're in that particular type of a role. So again, 2 months into the year, we're actually right on track with what we expected. Now, as I always want to point out, while the financial markets can seem very reactionary, they're really forward-looking, so it's always important to weigh the current economic picture against potential trends and developments down the road. As previously discussed, one major factor driving future confidence for investors is the fact that the Fed, after bringing short-term interest rates up over 5%, now has plenty of ammunition to deal with any pending economic downturn by lowering interest rates again. On the flip side, as I also noted, Wall Street's strength right now is still based largely on the artificial intelligence boom. And if there's one thing we all know about the tech business is that it can burst, right? That may or may not happen this time around. Maybe it's not a bubble, maybe it is, but the potential is always there when it comes to speculative investing. Beyond that, it's also important to remember that many things can disrupt financial markets, including natural disasters and major geopolitical events, and there's certainly plenty of the potential for that type of thing to crop up this year. And let's not forget about the fact that this is a presidential election year and probably a rematch of the most contentious and divisive election in recent memory. Although in my experience, the ultimate result of the election typical of have little impact on the actual markets, but the tension leading up to it can trigger some substantial volatility. The main point here is, of course, that it's very important to stay informed, which is precisely why I strive to help you do that through my monthly videos. So do continue to make good use of those videos, and feel free to reach out to our office at any time if you have any questions or concerns. In the meantime, continue to enjoy the relative calmness of the markets right now, and enjoy the rest of your winter, your Easter, and, at long last, the start of spring. And finally, from the entire team at Fellowship Financial Group, we just want to say thank you for allowing us to serve you in accomplishing your financial goals. We take that responsibility very seriously, and it truly is an honor to serve you. Have an amazing month. We'll be back again soon with another market update.